All right, welcome to The Explainer. Today, we're unpacking the first half of 2026 for Rathbones Group plc. This is honestly a really fascinating moment for the UK wealth manager. On one hand, we're looking at a story of highly resilient top-line growth and some pretty impressive asset accumulation. But on the other hand, the firm is navigating some very recent and honestly rather costly regulatory hurdles. It's that classic corporate tension, right? Commercial momentum pushing against operational friction. We're going to break down exactly what this means for the business, pulling directly from their latest interim results.
Okay, let's dive right into this. We'll be hitting four key areas today. First, their strong first half results. Second, the FCA regulatory review. Third, how they're executing strategic priorities. And finally, their outlook and future targets.
I want to start by anchoring us with this massive figure. £120.7 billion. That represents Rathbones' funds under management and administration, or FUMA as we call it, as of June 30th, 2026. This isn't just a big number for the sake of it. It represents a 10.7% year-on-year growth. Grasping the sheer scale of the assets they're responsible for is absolutely crucial if we want to understand how the rest of their financials behave. You know, when a firm manages this much capital, even marginal shifts in efficiency or client retention have massive impacts on the bottom line.
So, moving into Section 1, strong first half results. Let's look at the good news first. This quote from Group CEO Jonathan Sorrell really perfectly sets the tone for this reporting period. He says, "The first half of 2026 has been demanding, but it has also demonstrated what Rathbones is capable of." This anchors our entire narrative today. What we're looking at is a highly resilient corporate business that's successfully pushing through a tough operational period, all while being buoyed by continued healthy gross inflows and growing momentum right across its divisions. To actually see that resilience in action, we just need to compare their underlying profit before tax. Now, to translate that into plain English for a second, underlying PBT is essentially the profit the business generates from its core day-to-day operations. It strips out any one-off shocks or exceptional costs. In the first half of 2025, that sat at £107.7 million, but in H1 2026, it jumped to £123.2 million. That's a very clear upward trend and a seriously impressive 14.4% increase. It tells us that despite any external challenges, the core profit engine is humming along incredibly well. And that strong profit engine translates directly to shareholder returns, which brings us to this figure, 32.0 pence. Rathbones increased their interim dividend by 3.2% to 32.0p per share. Now you might be wondering, why should we care about a seemingly marginal dividend height? Well, a dividend increase in the face of upcoming corporate expenses is a massive signaling mechanism. It signals management's absolute confidence in the company's underlying capital generation and their commitment to a progressive dividend policy, even with some pretty clear headwinds on the horizon.
Which brings us to Section 2, the FCA regulatory review. This is the but in our story today. First, let's just define what actually happened. On June 16th, Rathbones announced a regulatory program to address recommendations from an FCA skilled person review. For anyone outside the compliance world, a skilled person review is an independent review mandated by the Financial Conduct Authority. It's designed to deeply assess very specific areas of a firm's operations, risk, or compliance. In Rathbones' specific case, this involves redeveloping their customer risk rating methodology and basically enhancing their due diligence processes. It's essentially an expensive regulatory speed bump that requires a lot of rigor, urgency, and transparency to finally clear. And here is the immediate financial sting of that speed bump. Rathbones recognized £19.0 million in costs relating specifically to this review in just the first half of 2026 alone. To be exact, $15.9 million of this is currently being held as a provision on their balance sheet. That's to fund the ongoing targeted review of client files and the remediation process. It's a significant chunk of change, and they've classified it as a non-underlying exceptional cost. Now, what's really interesting about this slide is how this regulatory review bleeds directly into their forward-looking profit margins. One of the direct actions Rathbones took in response to the review was to completely cease charging fees on the cash element of client portfolios. By giving up that specific fee revenue, they expect to lose about $9 million in operating profit over the second half of the year. Consequently, they actually had to drop their critical Q4 operating margin target from a robust 30.0% down to 28.7%. It just perfectly illustrates how compliance changes have an immediate, tangible impact on operating leverage. Let's pivot now to Section 3,
executing strategic priorities. Let's see how leadership is handling this. Back in February, CEO Jonathan Sorrell laid out 4 very distinct strategic priorities to make Rathbones the best wealth manager in the UK. They are becoming the first choice for clients, the first choice for talent, the most effective operator, and the most reputable brand. Now, these aren't just corporate buzzwords. They are the actual foundation the company is using to fund its recovery and ensure continued growth. Let's look at how they are actually executing on these right now. Regarding being the first choice for clients, client asset retention is everything. In the second quarter, a really fascinating dynamic emerged. The wealth management division saw positive net inflows of $0.4 billion, demonstrating some great momentum. However, the asset management division saw net outflows of $0.4 billion, which was mainly driven by industry-wide pressure on active equities. Because the wealth side performed so strongly, it completely offset the asset management outflows, keeping the overall group flows for the first half broadly neutral rather than negative. To become the first choice for talent, Rathbones is aggressively modernizing their workplace, specifically through artificial intelligence. The leap in enterprise AI tool usage here is pretty stark. They went from 22,000 hours in February to over 56,000 hours by June. They're integrating AI to speed up marketing, software development, and analytics. A recent internal time and motion review found that their advisors spend only about half their time on actual client-facing activity. By using AI to heavily reduce that administrative burden, they're boosting productivity and freeing up their top talent to do what they do best, manage relationships. And this brilliantly illustrates their goal of becoming the most effective operator. Look at this steep drop in acquisition and integration costs. In the first half of last year, these costs sat at $23.2 million. This year, they have absolutely plummeted to $9.5 million. This proves the business is successfully moving way past the heavy lifting phase of their massive merger with Investec Wealth and Investment. As these integration costs fade away toward a projected end in 2027, it frees up crucial capital to absorb the temporary shocks of that regulatory review we just talked about. Let's move to Section 4 and see how this builds into their outlook and future targets. Looking directly at the official RNS documents containing the financial highlights, the numbers literally don't lie. Despite that £19 million regulatory provision weighing down their statutory profit before tax, the underlying fundamentals, like that 14.4% rise in underlying PBT we saw earlier and an 8.6% increase in operating income to £487.5 million, they just remain exceptionally strong. So the crucial point is captured perfectly by the CEO here. Strengthening governance, improving processes, and simplifying the organization will leave Rathbones a stronger business than before. Management is intentionally framing this costly FCA skilled person review not just as a penalty, but as a real catalyst. By forcing them to streamline governance and improve client data right now, it inherently accelerates their strategic goal of creating a much more effective, scalable, long-term operating model. Which leaves us with this final, really provocative thought to consider. Will the long-term benefits of the Investec Wealth and Investment integration, alongside their aggressive AI adoption and core business momentum, ultimately outweigh these short-term regulatory costs? Rathbones is essentially betting that their fundamental top-line growth and strict strategic discipline will easily absorb this current speed bump. Thank you for joining this explainer. It's a complex, constantly evolving story of a UK wealth giant in transition, and we hope this breakdown has helped you grasp exactly what is driving their numbers today.